Good morning, ladies and gentlemen. Well, it looks like the risk dial is firmly in negative territory, which means that all these bounces, all they're doing is basically not changing the shape of the moving averages of the spreads, but just retracing the very sudden fall. And until this risk dial starts going positive, I can't really see anything but equities returning to the testing these lows up here, i.e. basically going back to where prices were before Trump introduced the tariffs, and then probably another swoon down. Overall, that is what I see, because real rates are not coming down, they're going up. And I've been saying for a long time that real rates need to go higher, and that is precisely what is happening. So here we have real rates, and you saw last week a huge jump higher, and this isn't even including Friday. Now, if we go back to the maximum, we can see that this was October and November of 2023 when the big change in policy occurred. And I remember, because I traded it, 255 was the high. Not 252, but it was 255. I remember it distinctly. If we return through there and bust through, we're going to 275 to 3 area, and that should be the top. That should be a wonderful area to invest in. But let's have a look at that in more detail. So the best way to look at real rates, because there are not that many instruments, is TIPZ. That is the longest duration real rates, naturally unadjusted, because if you adjust it, you get all the cash flow from the dividends, and that is not what you want. You want it unadjusted. And if you look back, this goes all the way back to 2010. I remember, because I bought it right here and then I sold it right there. So that's the level to look at, basically 50, 80, that kind of level. If we start breaking through there, things are going to get very, very nasty. Now, do I expect that in the next couple of weeks? Absolutely not, okay? But the trend should be for higher real rates. And every time TIPZ gets back towards 53, you're supposed to sell it, and you're supposed to be selling nominal bonds as well. When we get through there, and I think at some stage this year we will, that is going to be the panic, and that is going to be the bottom. You want to invest in equities when real rates are very, very high. And the US cannot take 275 to 3% real rates. It just can't. So if real rates get there, that will mean that equities will have swooned back down, and that is when you want to invest. Certainly you want to keep away from long duration until that happens. Last week was a week of both deleveraging and also liquidation of dollar assets, repatriation, in other words. I think a lot of European investors are not looking at yield, they're just selling their US dollar assets and taking the money home, and that is distorting just about everything. If we have a look at what the yield curve did, 2s10s, basically it didn't do a lot, but it continues to steepen. If we look at, though, at 5s30s, that actually flattened very, very slightly. But the trend is all of steepening. Now, 5s30s, can they get back to 61? Well, great. Let's do some steepeners there. What I'm saying is keep away from long duration. Long duration is not a good place to be, certainly not until real yields get to new highs. I think we will get there. We won't get there in the next 1, 2, 3 weeks, but we will get there. It makes sense for, in this period of complete uncertainty about what is going on, for real yields to remain high. Tariffs will have an inflationary effect. CPI will automatically go higher, and I think real yields will go up automatically by, not because inflation is ripping, but because nominal yields are not coming down as inflation goes up. So you get real yields rising, and that to me means that you are still in a period where duration is offered. You just do not want to own it. So if you look at what 10s and 30s did, so 10s got right to 458. I think over time, next week we might see them easily down to 430, but over the next 4 to 6 weeks, I see them testing the highs. And if you look at 30s, this is not a pretty picture. If we turn to a weekly chart, you can see that all the real tops, occur around this 5.25 area, 5.25 to 580. I think that this kind of level, 540, cannot be excluded, and that to me is the direction of it. I think the Fed is on hold for a long time. I think the Fed will not do anything in May. It will do something in June or July, but the direction of it and the magnitude of it is going to be far greater than what the market is anticipating at the moment. Either we go into a full-blown recession and the Fed moves by 100 basis points per meeting, or we don't, and the Fed stays pat, inflation automatically rises, and they panic the other way. We are in a very unstable position. I think we will both have big moves up and big moves down, but in long duration, the likelihood is that we have big moves up more than down. Who is going to fund this deficit? Is the deficit coming down? I don't think so. I think if we go into recession, the deficit will actually go up. And if foreigners are repatriating, the last thing they want to do then is come back and fund. Yes, they'll fund at a higher level, but we are not at the higher level. We need to get to the higher level for them to come in and fund. And this is just not expensive enough. It just isn't where I would want to invest in the US if for the past 2 or 3 months all I've been doing is selling US assets. It just doesn't make any sense to me that you want to be bullish of the long end of anything, of any market, because if the US long rates go up, it'll cause panic in all other markets as well. So here we have a weekly chart of the 10s US Germany, and you can see what happened, and this is pure repatriation. Where is a natural top? Well, how long is a piece of string? How much repatriation needs to happen is the real question. I would have thought that this 202, 203 level is a natural level to probably go short of it. Is it going to hold? Who the hell knows? The relationships are breaking down, and that is the problem. I'm borrowing this chart from a sub, but you can see how the relationships are breaking down. This is a chart of the US dollar in this sort of yellow, i.e. Euro USD, and the white is the differential between the 10-year note in the US and Germany. Normally it trades very much in sync, and this is what I keep on telling you nearly every week, that whatever the differential does, the US dollar is going to follow, and the relationship has completely broken down. We've had a big move in the differential tens, as you can see, down towards 2, and we've had a big move up in the US dollar. A big move up in Euro USD rather, and a big move down in DXY. I will look at DXY in detail later, but what that tells you is that it's all repatriation, that the foreigners are basically losing faith in the US dollar. They're losing faith in the policies of the Trump administration. They're taking their capital back home by selling whatever they were invested in, mainly US bonds, I would guess. Long duration as well. They're selling it. They're doing the FX, and they're then investing in their domestic markets, i.e. bonds. But that can't last forever, as I told you last week. That can only last while the flows happen, and once the flows have terminated, the only way for the US dollar to remain weak is for those differentials to come back in line at a different level. These differentials will come back in line, and that spread between the Bund and the 10-year note will revert, but only once those flows are over, and this is a headline-driven market and a flow-driven market through positioning. Who knows how long it takes for the positioning to unwind itself, but once it happens, this will revert back at a higher level. Okay, back to a weekly chart of the Bund. And to me, it's telling that it can't break down with all those repatriation flows. It couldn't break down below this 258 to 252 area. That to me is so important. It keeps on bouncing off it. I think, and you know what I think, that this is going to go higher in, within weeks. And if I change it to a monthly, I think we will definitely retest the 285 and in time go up towards 365. I just don't see any hope for it. Why would long duration in Germany, when they're reflating fiscally, start coming down hard? This is what the market would do when there are repatriation flows, and the fact that this is so shallow, it really is very shallow, even on a daily, right? Well, what have we done the past week? Nothing, right? Net nothing. We keep on trying to do better in the futures. As soon as we get to these levels, nothing. So I think that eventually we are up here in the 290s again. And you can tell that it's risk off, repatriation flows, flights to safety, whatever you like to call it, by looking at the spread. This is Italy against the tens, and you can see it's at this very, very important 122 level. People are definitely fleeing to safety, repatriating, sort of whatever, and this is getting dangerous, as is Germany against France. It's threatening to start breaking down again. So I would not be long of Italy. I would not be long of France. I definitely don't want to be long of Germany, but what that tells me is that when things calm down, you're going to have a big move in these European bonds, and it's not going to be down, it's going to be up in yield. The US dollar was definitely the story of the week. This is massive repatriation. We got exactly to where I thought we would get to, and where the stops were below 99.50 in euro in the DXY. And this is that level there, 99.57, covered everything below 99.50, and then we went and closed back 99.79. After what Trump did over the weekend, i.e. he lowered those tariffs on iPhones and semis, etc., you will definitely get a little bit of a risk-on move, and therefore the dollar will stop going down and will probably go and trade in this area. And I'll enlarge this because I think it's very important that you should see where we're going to go and where we're going to stay, as it were. I think that this is what we're going to do. We're going to go and trade somewhere between where we closed and up towards 101.90. I would be very, very surprised if next week we can break through 101.90, and I think every time DXY gets up there, you're supposed to be buying puts in size. This move is not over in the long term. It's going to be, this is a month's worth plus of trading here. I think that we're going to get much the same kind of thing. Every time we get to 101.92, I'm a big buyer of puts. Let's put that into a Euro USD context. I think these kinds of levels between 111.80 and what is that, 110.60 are going to be where we go to, sort of over the course of 2 weeks. We make some sort of a bull flag and then we will go again. So really 110.70 is the kind of level that I am looking at to go long of euros. I think that we shot our bolt on Friday. I got out, retracement down here, and we go again after a few weeks. I think that we've done too much for now. Repatriation flows can continue at maybe lower levels, and then we get some news that takes us back down towards 110.60, but then we go again. To me, this kind of level is an accumulation level for euros. I keep on looking at commodities and I keep on wanting to pull the trigger and buy them, but then I chicken out and I do nothing. And they got to a really attractive level a few days ago around this 20 area where I should have bought them, but I didn't because the risk reward was a close below 1977, in which case you go, you get out, or it goes back up, and it went back up. I chickened out and I did the wrong thing. I think it's impossible for gold GSG to keep on going up like it is. It just doesn't make any sense to me that the producers of commodities are going to accept a lower price in real dollars constantly. It just doesn't make any sense. And I think at some stage, unless we go into a very, very deep recession, this has to come back to more normal levels. And where are the normal levels? They're down here. Because if you say that gold is real money, which cannot be inflated away, and commodities are, much the same thing, this kind of thing level is the right kind of level. At the moment we are in, what can I say? We are in a ridiculous situation where commodities are constantly getting cheaper in real terms. I don't think that that can last forever. I think that if you are running a very long-term portfolio, you want to start buying some commodities and just, putting them away. Gold against tip keeps on going up, and I just don't see how that can continue forever. Once you get really high real rates, then why hold gold? I just don't get it. But never mind, that's just my problem. I can't hold gold, And if you look at a chart of gold, yes, it's going up against the US dollar, but if you look at it in terms of euros, it did very, very little last week, right? So it's stable, and that just shows you it's a repatriation flow. And once it stops, I think gold comes down with the DXY, because if DXY is now going to trade 1 or 2% better for a month, then gold itself should come down as well. Where should gold come down to? Well, probably this kind of 30-80 area. This is just unsustainable. Okay, so let's have a look at commodities in detail. I think the monthly chart is very important, and I think the 52.54 level is important, and I think the 47.64 level is extremely important. We just about ticked there during the night session, what was it, Sunday, and then we bounced off it like crazy. We will be even higher next week. So we know that these levels are extremely important. And then we can translate that and have a look at the 195-minute chart and what it says to us. We know that this is the Trump high on April the 2nd, and I think there are some odds that we trade it. 56.69, if seen next week at any stage, is a great risk reward for shorts, just a great risk reward. We are probably going to open at this gap here, and if there are enough shorts that need to be stopped out, 56.69 is the level that you want to buy put spreads. I think that for a month is going to be an absolutely brilliant level to be short at, long put spreads, for a return of a retest for at least 5,200. Let's have a look at NQ, because that is the one that should benefit most from the Trump move over the weekend. And actually it is by far the stronger market than SPX. We touch barely this 16,135 in that night session, and therefore it's not reflected on this chart. And the moving averages are still up there. 20,000, 19,950 to 20,300 on the monthlies, great risk reward for shorts. And if then we translate that to the 195-minute chart, we can see where that is. 19,900 to 20,000, let's call it 300, 400. That is going to be the area. We will top somewhere around here, and I think this is the first area that you want to start buying put spreads at, basically 19,900, which gives you, because this is NDX, which gives you approximately, I don't know, 150 to 200 higher in NQ. So just over 20,000 in NQ. It's going to be, just like in SPX, it's going to be a great area to buy some put spreads. Let's triangulate that with volatility. I think this 3011 level in vol will probably get broken to the downside. But if we can't go below 2280, I think that is your tell that the SPX and the equity markets in general are going to have another leg lower. And I really wouldn't be surprised to see 3, 4, 5 days coming down towards 2280, not being able to break it. Next week, it's okay, and then we go. Now, next week we have retail sales, and I think that is going to be a very, very important number for short-term trading, not for long-term direction, but for short-term trading. Why? Because it's got an asymmetric risk. So if retail sales are strong, everyone is going to say that, yes, this is front running by people of the tariffs, and everybody went out there and spent their money this month to avoid the new price hikes that the tariffs imply, and that next month we're going to just fall off a cliff. So if the equity market rallies briefly on a hot number in retail sales, they are then going to sell it, and that is your opportunity actually to buy the put spreads in the in the equity market. I think that naturally the opposite is going to happen in bonds. If you get a dump in bonds because retail sales are hot, you want to buy calls because the next move is going to be for higher prices, lower yields. So that is your opportunity. On the other hand, if retail sales are very weak, everybody will start screaming recession. And then you get exactly the same move, just you don't get the dip. So that is your asymmetric risk reward for next week. Retail sales is going to be, it's asymmetric. There is much more risk that equities fall after retail sales than that they go up. There's much more risk that bond prices rally after retail sales than yields go up and stay up. So what I want to do next week? Well, as I told you, I want the XY to get to these levels, and I want to buy put spreads on DXY and or Euro USD. I want to get long of it, i.e. calls on Euro USD. I still want to buy some GSG if there are big drops, and we could get a big drop if retail sales are really weak and everybody starts screaming recession. But the one thing that I definitely want to do is, if we see that level that I'm talking about, you want to have put spreads in the SPX because it's just asymmetric risk reward. Very, very asymmetric risk reward at those levels. Thank you very much indeed, and tweet you tomorrow.